In today's video, I am going to be giving you some fantastic high dividend ETFs. These are absolutely amazing, so let's get down and let's check these out. So this first one may not be a surprise at all. XYLD has a massive dividend of 9.5%, 9.58 to be exact. And the expense ratio versus Canadian ETFs, covered call ETFs, is actually not too bad at 0.6%. That's absolutely amazing. However, the average volume is also amazing too at 239,000 shares traded every single day. Now, there is something that is quite interesting, and that is the volume recently on every single covered call ETF will blow your mind. Now, this may signal, I've mentioned this before in other videos, that covered call ETFs are a good signal as to what's going to happen into the future, which is why I've been saying that people need to be getting into dividend paying stocks, because there's going to be a massive switch into dividend paying stocks and ETFs. The reason for that is money is going to get more expensive, inflation's also going up, which means that people generally flip-flop over towards blue chip and high dividend stocks and ETFs when stuff like that happens. So I've been saying this for about 6 months now, and now they're finally starting to say it on CNBC. And this is what I'm talking about right there. Check out, since the middle of 2017, the volume right there. Those little small lines seemed like a lot. And then there was a little bit of a spike when there was that massive volatility when the market was plummeting. Because guess what? When this ETF was down here, the dividend was ridiculously massive. However, the move into stocks and ETFs with a high dividend is going up drastically. That massive shift that we are currently seeing in covered call ETFs that have a massive dividend have just massive volume right now. And this is what I am telling everybody to move right now into dividend paying stocks and ETFs, because the market is really starting to shift over to that, because money is no longer cheap, which could hurt Bitcoin and Ether for a bit of time. I'm not too sure just as of yet how interlocked that is with the market as of right now. However, when it comes to tech stocks that do not pay a dividend, there may be some volatility. Tesla may not get hit because there's a big shift into green technology, but there is definitely a massive shift over to dividends. And we can see that it's currently trading roughly in the middle of its long-term average. This is its dividend. Of course, it does pay every single month. And when we compare year over year, unlike the Canadian covered calls, the American covered calls, because there is still that volatility that is happening with the market, you're still going to be seeing some increases in its dividend. Now, the top holdings, other than this one, because that's a call option, other than that, these are its top holdings, and we can see that Tesla, that's a big shift over to green technology. Amazon's been having a hard time recently. These are all mostly 99.9% of them are, in my opinion, tech holdings. However, there are a few that are not tech holdings. This is going to be covering, like it says here, mostly a generalized market. However, the generalized market is largely technology, in my opinion. This one may be a bit risky to the downside because of the current shift. However, it is still a very strong ETF because it covers the NASDAQ as a whole. And I think the NASDAQ is going to do okay this year, at least in the second half. The first half may be a bit volatile, which would then, technically speaking, help out the cost of covered calls, which then could make you a bigger income maybe. It's hard to say. However, this ETF does trade 34,000 shares on average with an 11 point, I almost messed up. I almost said that's 11% dividend. It's not. I've done the math on this one. It's around 7.25%. And of course, it's got that 0.6% MER. I keep on losing my words right now. But either way, it's an MER 0.6. Not too bad considering Canadian ETFs that are covered calls are usually around 0.7. It's not a very old ETF. It has been growing, but so has the market. We've also seen since the start of 2021 that the volume has also shot up. Even with this downturn in the market, it's also been shooting up with the volume as well. So keep that in mind. It's kind of interesting to see this ETF. I wouldn't necessarily buy it right now, considering tech is not doing so well, especially if they keep on trying to raise interest rates. But either way, still very interesting. Now, if we continue to the dividends, we do see that it did pay a massive dividend in December. And if you received that dividend because you owned this ETF, you are one lucky person, because that is one heck of a dividend. Don't expect that in the future. However, usually what happens with brand new ETFs when it comes to covered calls is usually they try to store a little bit more money at the beginning, which means that they will give that special dividend near the beginning of starting an ETF like this. However, I would not expect that big of a dividend to happen next December. That is just telling me that they will be upping their dividend throughout the year, because they understand that they're going to be able to maintain that higher part of a dividend. Just it's not going to be $3. I can almost guarantee you that. Its top holdings are obviously all tech. It's a NASDAQ ETF. Some of the big ones that are going to continue to go up throughout the year is going to be Apple. Microsoft, it went down the other day when it purchased that gaming company. However, Tesla is a green technology. Nvidia is graphics cards. There's going to be even more people needing graphics cards in the future. PayPal is like the payment system of everybody these days. These are solid stocks. In fact, I have looked up the actual website of this ETF, and it is 6.17% yield. So just to correct myself from earlier. This next one is QYLD instead of G. This one pays an 11.8% dividend, which is a bit higher, with a ridiculous average volume of 4.7 million shares traded on average every single day. Again, I really want to point out this massive shift into volume when it comes to covered calls. This one doesn't tend to do as well in the long term. Obviously, if you picked it up here, you're doing extremely well for a very long time. This one also did have a special dividend too, but it was not as high as QYLG. Again, same idea as stocks minus the covered call. This next one is JP Morgan, JEPI. This one long term is fantastic. This one has a yield of 7.6%. 7.56% with an average volume of 1.1 million, 1.2 million shares traded on average every single day. And the expense ratio is much less. I like this one a lot. It's not a very old ETF. It was 2020 that it was had the inception. However, it's had a pretty solid trajectory up. And again, same thing, higher volumes recently. This is a trend that we're seeing across anything that has a dividend, especially a high dividend like JEPI. Pretty solid earnings as well. However, just like in Canada, when it comes to the dividend year over year, it has gone down slightly. That could be just because of what they're investing in. The volatility has gone down, so there is that possibility here. Some pretty solid companies as well. This one's kind of interesting. NUSI, NUSI, Nationwide Risk Management Income ETF. This one is a 7.5% yield, much higher MER, and pretty good volume as well to get in and out of it. Somehow in recording, I forgot to put the chart down. However, it's pretty well staying within a $2 to $3 range, and of course, volume again is up. This one does pay a monthly dividend, which is nice. So if you're looking for an income replacement, this is definitely a fantastic option. Solid companies too, Apple, Microsoft, these are going to be redundant names when it comes to these ETFs. This one's a little bit different. So this one here, what you are getting is an 11% yield. RYLD, it's going to be really doing a covered call against different Russell 2000 stocks. Higher volume, again, recently as well. It's pretty much traded sideways really recently too. This is obviously that COVID blip, and then here is when the market's starting to sell off towards more risky or away from riskier stocks. The Russell 2000 is into riskier stocks. Higher volume in this ETF. However, when we see this and the market is shifting away from these types of stocks, if we can see this dip maybe a bit lower, it might be a good entry point. So this is more of a look and see and watch and see instead of an actual buy now. None of these ETFs I'm talking about today I actually own, just so you know, for transparency reasons. I am a Canadian. I am not an American. I can own these ETFs. I just choose not to. And the reason why I don't as a Canadian is because we do have high dividend ETFs up here that can give me just as much of a dividend yield, and I don't have to pay American and Canadian taxes on it. I just have to pay Canadian taxes. So it's a bit better in my opinion in my situation anyways. We can see that the dividend is pretty solid every single month. If we go year over year, we can see a little bit of a rise too, which is nice. We want to see that. And this one doesn't hold individual stocks. This one holds the Vanguard Russell 2000 ETF, and then of course a covered call against it. I hope that these videos are helping you, and I hope that this does help your investment journey. If it does, hit that like button, subscribe. Remember, don't trust every random person on the internet. Make sure to do your own research and to know what you are investing in. I hope that you've enjoyed. I'll see you guys again next time.